Welcome back to A4 Financial Audit and Investigation. Today we'll be talking about the two types of insurance that will give you the overall confidence that the recorded figures in the financial reports are fairly stated. Let's talk about the first type of assurance that must be conducted before you move into the final testing, and that is control assurance. Control assurance is basically analysis of the entity's internal control as it relates to the recording of the numbers in the financial statements. So even for the smallest entity, the auditor still has to do some work on controls at the planning stage. Why? Because controls will impact on the risk of material misstatement. The auditor should obtain an understanding of the control environment, the entity's risk assessment process, the information systems, including the related business processes relevant to financial reporting and communication, the control activities, and finally, the monitoring of controls. And if these items sound familiar, they are the five interrelated components of the COSO framework for internal controls. When it comes to that planning stage and understanding the controls and identifying controls that will be needed to be tested to give support to your audit as audit evidence that the numbers in the financial statements are fairly stated, you first need to go through a four-step process. One, the first step is to identify what risk require mitigation. So in this scenario, you have already done an understanding of the business and you are also performed a risk assessment on your own as to what are the threats to certain areas of the business, what are the threats to sales, what are the threats to payroll, what are the threats to fixed assets, expenditures, revenue. You have identified all the risk and threats to these areas of the business. In step one, you will then identify what risks have been you picked up for all those risks that should be addressed by internal controls. So with those risks that I identify, you're going to now look at the controls that the client has put together that would address the risk. So if there's a risk of ghost employees in payroll, then the company has to have a control activity that deals with the threat of ghost employees on payroll. Step two requires that now you document these relevant internal controls that mitigate those risks that you identify are critical to the financial statement audit. In step two, it's really a breakdown or a narrative that you need to document of how a transaction moves from the inception to the financial reporting under the internal control that exists at the entity. Your documentation needs to address each of the five interrelated components of internal control through the COSO framework. And we just discussed that in the previous slide. Step three, assess internal control implementation. Step three goes hand in hand with step two because as you're doing a walkthrough of a transaction within the internal control framework, meaning that you've identified the policies, the control, you're looking at the policies that would mitigate the risk that you have identified need to be mitigated. And these are the key controls. So you're going to do a walkthrough of those items and you will take one transaction from the start to the finish to one, document the control, and then two, to determine whether it's actually implemented. So two and three is actually working simultaneously. And in the result of step three, you will ensure that controls are actually operating as they are designed. So as the policy is being implemented, you're ensuring in step three that it is actually working as it is designed. Step four then comes with the final analysis of whether you're going to rely on these controls. And that is you're going to assess the internal control design. So step 2 and 3, you're basically analyzing that the control is actually in place and it has been implemented, meaning the employees understand it and they're actually taking transactions through the policies and procedures or in accordance with the policies and procedures that have been designed to mitigate risk. In step 4, you're going to actually determine now, based on looking at the control, looking at the transaction being implementing in it, you're going to assess whether it is properly designed to actually mitigate the risk. So the risk is with all the employees that work at the company and the policies relating to ensure that there is no ghost employee that will be located on payroll, that the policies and procedures that are actually implemented does prevent that, meaning that you've walked through the process of payroll, you've determined that they've had certain control activities that would prevent, they claim would prevent ghost employee from the payroll, but then you've seen avenues in your analysis where ghost employees can still go through payroll. And so the design is ineffective. So out of step 4, you will actually be matching the risk with the controls, the ghost employees with controls, and determining one of two things. One, you could identify the controls that prevent ghost employees from being on payroll as being effective in doing so, and hence you will isolate those controls and test them on a sample basis to form part of your audit evidence that payroll is fairly recorded. Or if you find it that it's ineffective in actually preventing ghost employees from being on payroll, then you've identified a material control weakness that needs to be addressed. And you will not be able to rely on that control, and hence you will have to elevate your analysis of the payroll transactions as a whole, meaning that you will have to actually look at transaction in payroll and ignore the internal control. You will have to do tests to ensure different types of tests to ensure that ghost employees are not on payroll. So your test now becomes a substantive test rather than relying on controls and just dealing with the fact that it's properly assessed and you don't have to do any further work on the account of payroll when it comes to ghost employees. And so if we take the example of the ghost employee concept, if it did fail in design to prevent ghost employees, I would be taking more samples of transactions in payroll when it relates to employees. I will be taking a larger sample of the payroll transactions, meaning I'll be verifying payroll payments and maybe be selecting selective employees to ensure that they exist, that they're not ghost employees. I will probably go and visit the employees to ensure that they're actual valid employees, looking at their social security, confirming their identity. Those are the types of things I would do if I've come to the conclusion that the payroll controls that should mitigate ghost employees is not effective. It's not properly designed, and so I can't rely on that control. However, if I could have relied on the control, then and because it's properly designed, then I will be taking samples of the actual control, samples that it is actually effective. So I would be maybe taking a sample out of the payroll processes. If it's done like new hires, I probably would look at new hires as they flow through the system. I would look at terminated employees that they removed from the system, and that would basically confirm that the internal control is properly designed to mitigate those employees. And with that, if I verify that the control is working based on my sample, I didn't find any variance where that are not properly entered into the system then again, I would have to go back to doing a detailed verification of employees and actually visiting the employees and confirming their identities from out of the payroll system. So basically, that's how the four-step process works in understanding what controls you can rely on and what controls by design is not effective. So we won't rely on it. We will automatically go into detailed testing.